Looking at these numbers, 78% drop in foreign direct investment last year in comparison to 2009, and as I mentioned, below the African average. Should we be reading very much into these numbers? Do you think that it spells doom and gloom for FDI going forward?
No, it doesn't spell doom and gloom at all, but what it does show is that South Africa is not getting the FDI that we really need to generate the economic growth, take our economic growth to that next level. And you compared it to Africa. Africa in general is getting more than a share of FDI. So South Africa is looking very poor relative to a continent that's now certainly in investors' minds with a lot of money coming in.
Exactly. Well, I mean, when you see the rest of Africa, you know, and versus South Africa, and also just looking at the M&A activity, because it's quite interesting to see mergers and acquisition activity in Africa versus the likes of foreign direct investment. And there we saw, according to Thomson Reuters, that we saw a record flow in terms of merger and acquisition activity, coming in $44 billion last year, and that was a record number that came through. So the play between merger and acquisition activity and foreign direct investment, how do you see that happening in 2011?
Well, it's very interesting in the South African context because of what we do see here is a lot of that M&A activity. So typically you can think of FDI as both when the companies come in, set up new factories, etc., and when they purchase existing companies. And as I said, it tends to be the purchases of existing companies that we see in South Africa. So you see the data deal, all these big deals that we're aware of. But it's the real on-the-ground building factory type of FDI that you want in your economy. That's where you're going to see the skills transfer. That's when you're going to see new money coming in. That's going to generate the economic growth. So on M&A, South Africa is doing well. On FDI, South Africa is doing particularly poorly. Africa as a whole, outside of South Africa, it's doing quite well on both fronts, actually.
Well, you know, John, and as we mentioned, the African average was a 14% drop in terms of FDI. You know, when can we actually see this number rebounding? Is it important and imperative that we do?
Yeah, I wouldn't get too focused on that 14% decrease because the overall trend is certainly that African FDI is very strong. As I said earlier, it's getting higher than its share of global FDI, and Africa is really coming into investors' focus as a place where money can go. What you've probably seen, if you look at it in aggregate, is that FDI to Africa has dropped off over the past few years because of the crisis, there are a reduction in commodity prices. But as we all know, as you discuss every day, we're back to seeing record commodity prices. Investors will be coming back to these economies looking for new minerals, new mining operations that they can exploit.
Well, it's interesting to see that developing countries saw a 10% increase in foreign direct investment as well. So clearly other emerging markets are looking far more attractive than what Africa is looking right now.
Yes, and as Umtad pointed out, developing countries now actually get more FDI than the old world, the developed countries. So definitely investors' focus has shifted. We see that in terms of portfolio inflows. We've seen it in terms of the currency movements. We're seeing it in terms of FDI. Growth rates are doing much better in emerging markets. Of course, we're going to see that FDI.
Well, John, I'm glad you mentioned flows into the bond market and into the equity market because that is where we saw substantial increases in 2010 when it comes to the South African market. Why do you think that investors right now are looking more into the bond market and equity market as opposed to saying, well, let's embark on foreign direct investment as opposed to, you know, embarking on asset allocation in the equity market and the bond market?
Yeah, so two different investor bases. Institutional managers managing a lot of money. They're looking at emerging markets for new investment opportunities, higher yields relative to what you can get back home. So a whole rush of money into emerging markets. Last year, South Africa definitely getting its share, particularly because South Africa has very sophisticated equity and bond markets. We make up quite a large share, 10% more in some cases, of typical emerging market equity and bond indices. South Africa, by contrast, is seeing very poor FDI. Number of reasons there. The problems in the mining industry with rights, questions over land rights for agriculture, labour market problems, the small size of our domestic market. So South Africa, in fact, is very unusual in an emerging market context because our financial inflows tend to be portfolio in nature and not FDI. If you look at other emerging markets, FDI is by far the largest portion of inflows into those markets. Now, that's an opportunity as well for South Africa. If we can start to get some of our fundamentals right, then maybe FDI, you'd see substantial more FDI coming into South Africa, which would of course have implications in terms of economic growth, could strengthen the currency further, maybe not what the authorities want at the moment, but could certainly do that. So that's something definitely we've got to watch in a South African
Well, John, it's
context.
an interesting notion that, you know, we differ from other emerging markets because we see more equity flows and bond flows. Many are worried about that now being squeezed going forward. We've seen quite a bit of money going out of the bond market so far this year. Do you think that this trend could change into 2011 and perhaps investors looking at other emerging markets and other emerging market equity markets as attractive investment destinations?
Investors tend to move into or out of emerging markets in aggregate. So if they're selling South Africa, they're also selling Korea and all the others as well. So it's really a play emerging markets versus the developed world. And what we see there is that fundamentals in our view at Rand Merchant Bank are still supportive of money coming into emerging markets. The factors that drove money to emerging markets in 2010 remain in place, at least they will for the first 6 months of this year. Maybe towards the end of this year, if China starts to slow down and if US rates start to rise, then some of that capital can reverse. But for now, the trend is still capital coming to emerging markets. Seen a couple of weeks of selling out of our domestic bond market in particular, but I think that cash will return soon enough.